If you're 40 plus and you haven't saved for retirement, I don't want you to panic. You may be in your 50s, you may be in your 60s. I don't want you to panic. You don't need tons of money to get started. You don't need a lot of stock market experience to get started. All you need to do is to get started. Today, I'm going to show you a two-step, simple, low-risk investment plan that you can set up in minutes, and it works even if you're starting out late. Okay? So stay with me. So whatever amount you decide to do, whatever you decide to do or not do, I'm not trying to force you one way or the other, but I hope you're going to do. Because what happens to your monies in your later years if you haven't grown it or you're not continuing to grow it? At some point, you're going to deplete it. And you can be fixed living on whatever you have coming in. And if that's okay and you're settled with that, hey, more power to you. I'm just not the one. I want to increase my standard of living as I choose to, as I grow older, and not necessarily have to decrease my standard of living because my income can't keep up with the rate of inflation. Well, welcome to another episode of Living Each Day on Purpose. I'm B.A. Ingram, and I'm excited that you're with me today. Hopefully, you've been following along in the series as we continue talking about how to help you show up your investments in retirement. And even if you haven't gotten started, how to prepare for your retirement using dividend income. So, here today, what I want to do is I want to share with you quickly some things as to how you can begin working on your retirement plan and how, no matter what your age, no matter what your income level, matter of fact, you can begin starting today. And if you get started today, as I've said before, every day that you invest it, every day that you put money aside is one more dollar earned and one more dollar gained. Every day that you don't is not a dollar earned, not a dollar gained. Building an investment portfolio doesn't have to be complicated. Even if you're starting out late in life, it does not have to be complicated. But what if I showed you today a stress-free way to start investing? Would you take the first step with me today? Because I'm going to break down for you a low risk, easy way to manage your retirement portfolio using ETFs and REITs that are perfect for you as a retiree and show you the simple step that removes all the guesswork. Because what's the most important thing is to get started. And many people get stuck on getting started. Many retirees avoid investing because they think it's too complicated and it's too risky, especially as we get a little older. We don't want to necessarily lose our money. We want to make sure that it's working for us as best that it can. And as you've heard me say before, a traditional savings account isn't going to help you do that because it's not keeping up with the rate of inflation. It's not growing at a rate to outpace inflation. So it's going to be very difficult to maintain your standard of living today, tomorrow, and the days ahead as things become more and more expensive unless you find a way to increase income or have additional income to keep up with that. And you don't need to pick individual stocks. You don't need to try to time and play the stock market. You don't even need to watch the stock market every day to do what I'm recommending. And here's two simple ways to start your portfolio as a retiree that you can begin setting up in minutes. After you've set up your brokerage account and after you've funded it, put money aside in it, here is a suggested way. Whatever amount that you decide to start investing with, here's what I'm recommending that you begin with. And you can change these numbers around however it pleases you. But start off with putting at least 60% aside in an ETF fund for stability and growth. Why is that important? Because the right ETF is going to pay you dividends, which is recurring income every month or every quarter. And that's important because that's going to help you shore up your income later on in life and have additional income coming in on a regular and consistent basis. And there's many funds out there that you can choose as an ETF, you know. And when you set up a brokerage account, whether it be with Vanguard, whether it be with Schwab, whether it be with Fidelity, There are plenty of funds out there that you can use. I am just recommending a couple to get started with. You can look at funds such as VTI or SCHD. And VTI allows you to own portions of stock in all the major companies or hundreds of the major Fortune 500 companies. There's thousands of stocks in this particular one fund. So you don't have to have hundreds of dollars to invest in, let's say, a Microsoft or an Apple or an Amazon, but you can still own Apple and Microsoft and Amazon by investing in this ETF VTI. You can also use SCHD, which invests in 125 of the top US companies as well. So you get big companies such as Pfizer, Walmart, and Target, and other companies such as that as a part of that fund. And so you don't have to just pick individual stocks, but using ETFs that allows you to pick from a larger pool of stocks that are already in this one particular stock. So you don't have to go individually trying to buy a little of this, trying to buy a little of that, trying to buy a little of that. If you've got thousands of dollars, hundreds of thousands of dollars saved aside to do that, you can. But I'm talking to people who are just beginning, just starting out. And so I want to start you off comfortably in doing that. And then if you put 60% into that and continue to do that, that will continue to grow. Then I recommend that you take 40%, the remaining 40% of the 100% that you're investing, and then invest it in a REIT, a real estate investment trust. That's going to also give you passive income, either monthly or either quarterly. And there's various funds, again, out there that you can look at, such as Realty Income, which is ticker symbol O. You have VNQ as well, which is Vanguard Real Estate Trust. It's an ETF. But both of these allow you to invest in commercial and residential real estate as well. So you look at your big Costco, your big Walmarts, your big facilities such as that. They don't own those facilities. They're owned by a REIT, and the REIT leases them back to those particular companies. So you can own real estate without the headache of being a landlord, without the headache of maintenance problems and maintenance issues, but you can still own real estate. And this is why I love investing in REITs, because it still allows me to be a landlord, so to speak, without the headaches of land ownership and home ownership. Not that I'm against that by any stretch. I just know as I got older, I didn't want the headache of having a tenant call me or the company that's managing the property calling me. I got to pay this. I got to take care of this. We got to upgrade this. We got to upgrade that. I invest in O, which is Realty Income, and I invest in Starwood Properties. And the reason why I invest in Starwood Properties is because I'm a Marriott Rewards member, and I love staying at Marriott's as I travel around the world. So I'm getting paid to stay at every Marriott I stay in the forms of dividends that they're paying me back every single quarter because I've invested in Starwood stock. Okay, and so here's a bonus tip for you as well. Once you've got your 60/40 set up into these accounts, part of it in an ETF, part of it in a REIT, then you go ahead and set it to what I call set it and forget it. Not that you just never look at it again, not that you just never come back again and visit it. Of course, you need to do regular and ongoing maintenance and things. But then I want you to set your dividends to auto reinvest. And why is that important? When you set your dividends to auto reinvest, what that means is every time you get a dividend payment, it is just going to automatically reinvest in that stock that you own. That way you don't have to worry about manually doing it. It's just going to automatically go back into that stock so you begin to accumulate it. And the power of reinvesting those dividends, they begin to compound over time. That $10, that $20, that $50 that you just made in dividend income turns into 20, turns into 40, turns into 100 as it continues to be reinvested and compounded. So with the money that you are investing on top of the dividend, your money begins to grow a lot faster and it begins to compound. That is the power of compounding. And when you set your ETFs and REITs dividends to just automatically auto reinvest, you watch your portfolio grow using the principle of compounding. Now, these are just some suggested percentages to get you started, but you can allocate them based upon your comfort level. Some other recommendations that are easy, you can do a 70-30 split. put 70% in an ETF, or 30% in a REIT. You can do a balance split. You can put 50% in ETFs, 50% in REITs. It's all up to you and what your comfort level is, and what your investment level is. You can do a growth oriented percentage if you want more REIT income versus less ETF income. You can do a 30-70 split. You can do an 80-20. Whatever your comfort level is based upon what you want to receive as dividend income. Here's in our classes, we teach you how to research dividend stocks, how to know what they're paying and when they're paying, how to know how much dividend you're going to receive back on that stock. So then you begin to set your portfolio up in a way that works for you. For example, one of my portfolio accounts, I look at it every month with my fiduciary, and we look at it and we make adjustments and changes as we need to based upon how that um, dividend income is looking. If I'm seeing one particular stock paying me more dividends than another, I may put more money into that fund. If I see one that looks like it's starting to increase, or they have published that they're about to increase their shareholdings and their dividend payouts, I might increase that fund. So you look at it over time, and you look at it regularly and consistently over time, and you decide how you want to make adjustments in there. When I see one that comes on the what I call the aristocrat list, or I didn't call it, but that's what it's called, the aristocrats, which are funds that have been around for 50 years or more, that have paid consistent dividends over time, and they've increased those dividends over the years. And when I invest in the aristocrat dividend stocks, I look for those that I want to do next, and then I might tell my fiduciary, hey, put this one on the radar. Here's where we want to start putting some money toward as well. So you get to decide where your money want to go. If you're just waiting for your broker to call you, if you got your 401k from a retirement plan, or you rolled over 401, from another job, and it's just sitting there and it's not doing very much, but you're receiving income off of it, at some place, at some point, that income is going to decline. What you receive back is going to decline. It's not going to last indefinitely if it's not invested in the right types of vehicles or assets in order to pay you regular and consistent income. And I'm not talking about other types of assets such as IUL and annuities and things like that, that you get a guaranteed income for life. We're talking about strictly investments right now, and building a portfolio that you can, in addition to, if you have those other assets at your disposal, you can have additional income coming in from an investment portfolio as well. Now, I understand that this may be a lot, may be overwhelming. Here's why I try to take my time, talk in simple terms and not be overly complex, and then explain terms as I go along so that you understand. So if you've been following along in this video series so far, I think we're in week number 5 in this particular series. I've given you most of the definitions and most of the terms that are applicable that I'm talking about. And in my class, I have a dividend investment e-guide that you get access to that breaks all of this down. And it also gives recommendations as to what we are doing as a company, what we are advising other people that we work with to do, and how we're managing our money in our retirement years. But I realize and understand that you still may have some questions, and I never want to leave without addressing. And I get questions in email, I get questions through my social media, and so I take time to try to address those. So some of the questions that I've gotten of lately is, number one, do I have to buy all of these stocks at once? Well, no, you don't. I suggest that you start with one ETF and then add to it over time. What I find out, if you try to do too many at one time and you do not see the gains that you would like to see, sometimes people get a little impatient. Sometimes they get a little disappointed because they're not seeing. I like to build up one ETF fund or one REIT fund to a point to where I am comfortable and I like what I'm seeing in the forms of dividends. And it could be 50 bucks a month or a quarter. It could be 100 bucks a month or a quarter. It could be 200 bucks a month or a quarter. That's not the important part. What the important part is, I want to see the consistency of the payout, because I know over time it will increase, it will compound, and it will bring in more. But you don't have to go out and try to pick 5 stocks at one time and start investing in all 5 and then get confused and then get overwhelmed and then you stop and you don't want to continue. I suggest building up one at a time. My preferred way of doing it and how I do it personally in my smaller account, because I do have a larger account that my wife and I live off of. We have a small account that I use for training purposes, such as this, that I demonstrate to my clients, that I show them how to do it using $25, $50, $100, whatever they can afford. And we buy and hold and sell in that account. We don't sell, we buy and hold. And I show them how to do that. In that particular account, I may buy more than one because I'm demonstrating to people that I'm working with how to do it. So in one particular account that I have three right now, and we buy those three regularly. We add to it over time. I may add to it every 3 months or every 6 months. I just added one since I'm into March now. So I'm into the third month period. I try to add another one every 3 months or so. So I just added one. So we're going to look at that in the next quarter to see how it paid in dividends. And once we see that working, we'll put a little more in that. We'll put a little more in the other two that we have as well. But you don't have to try to get too many at one time and then overwhelm yourself. Then you become disappointed and frustrated and you quit. Okay. Second question I usually get is, what if I want lower risk? And this is why I love ETFs and REITs, because they allow you to still invest with the stock market, but not at the great volatility, excuse me, volatility, as in just investing in one particular company and holding one particular company. Say, for example, you invest in SCHD, which has hundreds of companies within that fund. So even though one company may not be doing as well, other companies may be doing a little better. So you get the leverage from the others that are not doing well versus the one that are doing well. So it's not like if you just buy and hold one particular stock and it goes up and it goes down and it goes up and it goes down, and then your heart is going up and down with it, and you find yourself saying, I just can't take this. This is just not for me. I'm out of here, and I'm just going to save my money and keep and let it ride and do what it do, because I've been down that road and I know what that's about. But I love the consistency of dividends, because they're going to be paid out every month or every quarter, depending upon what you invest in and what the company said they're doing. You're going to receive that amount. And sometimes the bonus is you may get higher than what they thought that they could pay. For example, when they publish what dividends they're going to pay that month or that quarter, they have a target. They said how much you're going to get. It may be 50 cents on the dollar, maybe 40 cents on the dollar, 30 cents on the dollar. Well, they may beat that. They may come in at 31 cents, or they may come in at 45 cents, or they may come in at 52 cents. So they may beat what they've estimated to pay, which is always great for you. Now, the downside of that is they could come in short. It does happen. It doesn't happen often, but it does happen. But it's not like it's going to be a large percentage that they're going to miss it by, because their analysts have done the research. They know what they anticipate making that year. They know what they anticipate making that quarter. So they have already estimated what they can pay their shareholders back in the form of dividends. So it is a little lower risk. All stocks are at risk. There is no way you're going to invest in the stock market with zero risk. It's just not possible. So there is risk, but ETFs and REITs are at a lower risk than just, let's say, you go on as one particular stock in one particular company. Okay. And then finally, big question that I get, that was one of mine before I began this journey several years ago, is, can I live off this portfolio? I'm here to tell you, as a living example, yes, you can. Dividends, whether they be ETFs or REITs, can cover monthly expenses and even more as you grow your portfolio with more dividends. My main account, we are living off of those dividends that come in every single month. Hundreds to thousands of dollars every month that come into that portfolio. We get a check for those dividends. Sometimes we take it, sometimes we reinvest it. It's just depending upon what we have going and what we're doing. If we want to take a trip, we want to travel somewhere. When we relocated here to Panama, there was a lot of expenses behind all of that. We took some of those dividends to use that for some of the expenses that we had, and we didn't have to worry about money or finances or any of that, because the money was there and it continues to be there. So yes, you can live off your portfolio and live off these dividends. Okay? Well, I hope this has been helpful to you today. And if you want a step-by-step guide to getting started, I want to invite you to join by Unlock Your Freedom webinar. And it's a VIP webinar. I have the free webinar that you can take as well, but I have the VIP, which is the paid webinar where you work with me for 3 days in practice. I am there with you, working with you as you go through the training, helping you get things set up. I don't just leave you on your own, but I am there with you, helping you every step of the way through this VIP training. And you get access to our VIP community where I'm answering your questions, where we go into the nitty gritty, where we actually show behind the scenes numbers. I don't do that always out here publicly. I know a lot of people do, but I'm just that type. And it's not that I'm not to brag or boast about it. I just don't believe in sharing financial data with people because it's not the same for everybody. And what I'm doing, you may not see the same thing. And I can't make guarantees that it's you're going to make what I'm making or what somebody else is making, because this is an individual journey and everybody has to do what they are comfortable with. And if you do what you are comfortable with, then your portfolio will be what it needs to be to satisfy your needs. Okay? But in the VIP community, I do take you behind the scenes and I show you some of the numbers. I show you some of the data so that you can see that it's real. And I know there's people on social media who make a big thing about publishing that data, but I don't buy just because I see you got great numbers. I'm going to follow you for a while, see what you're doing, see if your logic is making sense, do my own research, and then make my decision if I decide to work with you. And I hope you'll do the same. And I'm not asking anybody to come along and give me any money and trust any money to me. I'm asking that you try these for yourself. And if they work for you, then I know that they will help you and bless your life as you continue to apply the principles that we share with you. So I hope this video has been helpful to you. And if it has, I want you to like and subscribe for more retirement investment made simple tips. I'm here every week. I'm starting in the evenings now at 6:15, trying to get people time who may still be working, who may still have other things going, to tune into it and not necessarily break their day during the midday and do that as well. But if you have any comments, any questions, you can leave them down in the comment or in the chat, and I will respond to them and get back with you. So I hope this has been helpful to you. I look forward to seeing you in the next video. Until then, take care. God bless, and I'll see you on the inside, hopefully. Take care and talk to you again soon. Bye for now.